Okay, I think we're ready to kick off. Welcome everyone. Really appreciate taking the time. I know we've quite the wide variety of attendees across the world, different time zones. That I'm sure it took our team a little bit of time to make sure we got all the time zones right in the invite. But again, really appreciate everyone's time and attention today. Just as by means of a quick introduction, Karl O'Brien is my name. I'm the co-founder and CEO of StoreHero. We're a real-time profit reporting platform for e-commerce. Delighted to be joined by Nathan from BlueSense. Maybe Nathan, you can give a quick intro from your side.
Thanks for having me, Karl. Australian e-commerce brand based out of Melbourne. We have worked with over 250 e-commerce brands. We do our best to tie financial outcomes into performance marketing. And so that's really a gap that I know you're going to be speaking to, and then I'll build on it with actual action items in the ad account. And I'll go into a little bit more detail once we get into that section.
Definitely. Yeah, plenty of topics to cover, plenty of kind of interesting conversation here. Having had a peek at some of your slides, I'm interested to see you share them. And I know there's going to be a lot of actionable takeaways for brands and agencies on the call. So excited to dive in. Cool. So with that in mind, we can get going. So just as a means of kind of an overview as to what we'll cover today, I'll take 1 and 2 just to kind of ideally set the scene a little bit as to where e-commerce is today and ultimately the kind of approach that's needed by brands and agencies in order to survive with the kind of macro dynamics that we see. Then we'll kind of dive into using contribution margin and in order to kind of survive and thrive in this environment, what is the language we need to speak? And contribution margin is a big part of that. From there, I think a lot of Nathan's content is really going to dive into taking that concept and putting into a practical form through the likes of your Meta ads dashboard, linking contribution margin to those Meta KPIs and kind of seeing both sides of the coin, how a per account structure can actually erode profit contribution, ultimately maybe sometimes moving difference to likes of ROAS, and ultimately kind of flipping that on its head. What does success look like? I'm putting you in a position to actually, thrive in the environment and this, the macro environment we find ourselves in. So, a pretty stark slide to start with. As part of these talks, I typically give, as anyone operating in e-commerce today knows that it's never been as easy to start an e-commerce business, but unfortunately, it's never been more difficult to grow that business profitably. Years of cheap customer acquisition costs, cheap capital, meant a lot of brands over the last couple of years never really had to be too dialed in on their unit economics, on their numbers in order to make e-commerce work. And ultimately, one of the key reasons why that's changed is these costs. So ultimately, we consistently see brands and agencies using revenue as a daily indicator of success, again, in an industry known for having such a complex cost structure. All of these variable costs, by their nature, are extremely variable. And with that in mind, if we're making decisions in absence of this information, we may not always lead ourselves to come to the same conclusion. We consistently see a situation there where you're maybe using those revenue metrics on a daily basis to make decisions, but ultimately that doesn't tell the same picture as the accounting conversation you have at the end of the month with your CFO, accountant, whoever is operating in that headspace. They're using different metrics. They're often siloed, and again, not what we're making our kind of daily decisions on as a business. I personally saw this in running a digital marketing agency based here in Ireland, and saw how data tracking and privacy challenges have made it really difficult for agencies as well, kind of adding more confusion, adding more fog to this environment as a means of kind of making those decisions. Really, that increase in customer acquisition cost, while it's something that can easily tick up and we kind of get used to, it's like the I suppose the lobster in the pot of boiling water. Oftentimes it's not as immediately visible, but it's only when we take a step back to understand how much of an implication this will actually have on a business. So ultimately, as we've seen those customer acquisition cost increases, it's changing the dynamic of every order we're driving on the store. Just using this as an example of a $100 AOV order, let's say, we have 30% product costs. Oftentimes that's maybe sometimes a first hurdle. Unfortunately, that doesn't represent the fully loaded cost of goods and other variable costs we need to see and deal with. But between our packing fees, shipping costs, transaction fees, our taxes, and ultimately any sort of profit we want to leave aside, in this particular case, it leaves us $25 to be able to afford to spend on marketing. And what otherwise might seem like a smaller, I suppose, percentage increase in that customer acquisition cost from a $25 to $35, which certainly isn't unusual based on what we would see brands experience over the last couple of years, that profit has gone from $14.55 to $4.55. So what's the implication there on that small, albeit small, change of the kind of overall pie of an individual order? I now have to do 3 times the volume of orders in order to maintain the same level of profit with this ultimately order structure. And that's a severe amount of pressure to put on a brand and ultimately an agency who needs to deliver results off the back of those individual metrics. One thing we see there, and as everyone on the call would ultimately see, I think there's some war stories being traded in the comments there, plenty of kind of therapy after to talk about, but everyone has really seen this, in the context of the X and Twitter screenshots. It's easy to represent that overarching sales goal, of sales kind of outcome even, but ultimately from here, it's not telling the full picture. This is really, again, to where we see e-commerce today. It's not enough, and the game can only last for so long to use revenue as that North Star, and profitability has become that kind of North Star focus for businesses out of a requirement. It's sometimes people have come kicking and screaming to it with us, and that's where we are today. And that ultimately sets up what we're doing at StoreHero. So just to give some context to kind of set the scene for the rest of the session today, really StoreHero is a profit platform for D2C e-commerce. So ultimately, it's not only are we syncing all that various sales and marketing data, but unlike other tools, we also sync all of those variable costs. So ultimately, the benefit of that is we can make decisions with a clear view of profitability on a store level, a product level, or an order level, amongst a ton of other iterations that we can look at. From there, we can identify and eliminate loss-making orders, activities, campaigns, but also promote our most profitable orders and campaigns, meaning no more guesswork in that Monday morning marketing meeting. Now, ultimately, a lot of the conversations that we would have seen over the last couple of years, ROAS ends up being that North Star, and it's certainly a much better indicative metric than what we used to have to rely on. Maybe it's just conversion count, likes, clicks, and impressions. It's certainly getting closer to that kind of metric that represents the business outcomes, but it's not perfect, and it doesn't often tell the full picture. We consistently see and hear conversations with brands, maybe dictating to an agency or dictating to their team, or even having maybe a sense themselves of what ROAS they need. Now, ultimately, that's such a variable question. Number one, ROAS isn't going to factor in those order-related costs. That product, packing, shipping, transaction fees, discounts, returns, and there's a ton of different variables in the middle there that ROAS isn't fairly and properly representing. Secondly, good ROAS is difficult, is different for everyone. Some businesses, ultimately need their unit economics and their margin structure requires them a 4x to break even. And some large businesses we would have seen and work with on the StoreHero platform can ultimately grow profitably with a lower ROAS. Often, it's more often than not that's the case. Oftentimes you might expect, and maybe without kind of being in the weeds of this kind of stuff, expect that, okay, a larger brand that maybe in your sector that you're keeping an eye on is there because they ultimately have a higher return on their ad spend. They've cracked meta ads. But oftentimes, certainly it's a case they're often investing in it heavily and they've a really strong setup there. You need that, but they're not operationally, I suppose, perfect. That's the big thing. What they've done is they have their underlying unit economics are set up in such a way that they don't need to be perfect. They can afford to scale and they don't have to turn off their ads anytime they drop below a 3. Oftentimes for that same reason, high ROAS can be a missed opportunity. If you have an opportunity to spend a larger amount at a lower return, that actually might generate more profit. And I can put this into a little bit more context in a second. And ultimately, attribution is not a perfect science, to say the least. I think the concept of attribution tools, we kind of are taking another stance as to not put ourselves in that category. There is a value to it, but oftentimes I describe it as, rearranging deck chairs in the Titanic. Oftentimes businesses maybe overly focus on attribution with apps in the absence of a clear view Am I actually profitable on a per order basis? Am I digging myself into the ground, or am I actually scaling profitably? And ultimately, it's not a be all and end all. The concept of having a perfect split as to exactly what each individual channel is responsible for is great, but it's ultimately not as simple as that a lot of the times. So what's the outcome for this for an agency and a brand? So this off, the challenge and the push and pull of revenue versus profit means most people on the call are going to be familiar with that up and down seesaw battle between spend and ROAS. You ultimately increase your spend, your ROAS falls. You decrease your spend, your ROAS increases. And ultimately, with that in mind, it's difficult to know what that optimum point actually looks like. In the absence of information, there's also a pressure to keep ROAS as high as possible, with the fear of, okay, well, at least if it's higher, that seems like it's better. So at least we're a little bit safer, but it may actually not be serving the outcomes and goals of your business. And because there isn't that shared language in order to understand what that optimum point is, it's very hard to have this conversation purely hypothetically. And really, we see the answer to this problem as contribution margin. So ultimately, if we can ask ourselves that question, like if we know there's more money left over after our cost of goods, after all our variable costs, and after our cost of marketing, that's certainly a good thing in most cases. That's ultimately what contribution margin is. So for those unaware, just to give a sense of a definition, that's going to represent your net sales minus your cost of goods minus your marketing spend. Now, there's a number of different contribution margin definitions, CM 1, 2, 3, but in most cases, this is, especially in our context, this is how we typically talk about it. So marketing spend could just be your ad spend, or alternatively, it could be ad spend plus software, agency, whatever the other incurred marketing costs, photo shoots that you might want to set. Everyone has a slightly different approach to that. And ultimately, the benefit here of using contribution margin rather than just using gross profit as a reference point, again, it can be great if you generate 50K in gross profit, but if you have 51K in marketing costs hidden there, that's not fairly represented. It's not truly answering that question. Am I better off having made that investment in marketing, made that investment in improving the efficiency of my spend? Is that actually delivered a better outcome for me? So really, that's why contribution margin can be a much better, clearer North Star in a lot of cases for a lot of brands. Just to kind of put this into perspective here, let's say we have business A and B. Both of them are driving $500,000, euros, pounds in revenue, whatever the case may be, and they're operating a 200K of ad spend. Ultimately, Shopify and Meta often treats these stores as exactly the same, but spending that ROAS metric is going to deliver very different outcomes for these two businesses. One business might have a 60% gross margin and see $100,000 or 100,000 euros in contribution margin or profit after marketing. That's what they ultimately have to show for themselves before their operating expenses, but ultimately the orders are contributing, that contribution margin is contributing, that 100K in this case. Whereas business B, with those tighter gross margins, while it might, it's again, very easily done, ultimately constricts what that pie chart, what's ultimately available to spend on marketing, and therefore in this particular case drives a zero euro or dollar contribution margin. These businesses shouldn't be operated in the same way, and they shouldn't have the same ROAS targets. So we need to have a clear conversation, and we need to ultimately have some language in order to do that. This is an example I often like to use to kind of put this in perspective as well, to try to figure out, okay, what is the sweet spot? It's the obvious example, an obvious next question, I suppose. If we find that, okay, we're trying to figure out, we increase spend, ROAS decreases, what's the optimum point? And it ultimately is going to depend on your business. And really what we're trying to find is the point of diminishing returns. At what point is the kind of maximum amount that I can spend to drive the total most amount of profit? Again, not just optimizing for ROAS. So in this particular case, let's say we're looking at a couple of time periods. So let's say we're looking at this over the course of a week or a month. It's the same concept depending on different size of brands. So in the first example, I spend 10K on paid advertising. I drive a 7.5 ROAS, and ultimately my 10K multiplied by my 7.5 gives me 75K in revenue. On the basis of a 60% gross margin, that leaves me 45K, just reading along the first line there. And then my gross profit after marketing, i.e. that contribution margin, is going to be my 45 minus my 10, back on my first column in spend, giving me my 35K in contribution margin. Now, ultimately, if you're trying to maximize your ROAS, you actually should probably stop spending there. But that again, that 35K in contribution margin isn't the most amount of profit you could generate. And what we can really see here is if we spend a lot more, even though our ROAS is lower, our profit per order might be lower in turn, but we're generating more profit overall. So in this case, we could spend 50, 75, 100K. My ROAS is maybe falling, and my revenue is increasing, and we can see that the point of diminishing returns, or the optimal point, is there. It's actually a situation where we're spending 100K. So again, based on our outcomes, based on the kind of metrics we're using as a gauge of success, we end up in a completely different picture here. And comparing that kind of first line of the table of 10K in spend to 100K in spend, we end up at a completely different level of contribution margin or profit out the other side. So again, a really interesting frame of reference there. We often find that once that clicks, there is a light bulb moment for everyone where they see maybe past that ROAS metric into contribution margin. And it takes some time to get there, but once you're there, you won't look back and use those other pure revenue-based metrics to kind of tell that story. One piece that we'd really recommend as well, there's a free resource that everyone might benefit from, which is our order profit calculator. And what this does is it actually goes back to that AOV, kind of $100 AOV example there, to actually help you map out for based on your average order value, and what can you actually afford to spend to acquire a customer based on your goals. And ultimately working from there, it'll map out, okay, whether if you want to be first order profitable, here's how much you can afford to spend. If you're willing to invest until the second order, here's how much you should spend, third, fourth, and otherwise. So even before you kind of dive into platforms and stuff like that, a clear view of what profit are you actually generating from an order, and ultimately how should you use that as a reference point. So before I kind of dive into questions, which we'll obviously come back to at the end, I'm going to stop my sharing here and pass it over to Nathan, who'll bring us the rest of the way in order to kind of translate these kind of ultimate profit metrics and concepts into practical decisions you can make within your ad account. So over to you, Nathan.
Perfect. Thanks, Karl. All right, so optimizing Meta towards profit contribution growth. I have to have a few slides, social proofing, as you always do. So I'll rip through these. We work with e-commerce operators to produce better financial outcomes, worked with over 200 e-commerce brands. Everyone in our team works direct to expert as well, so we don't have account managers. We have over $100 million in ad spend under management. I think it actually might be more than that by now. This is an old slide. And we have over 65 five-star reviews. Here's some brands we work with. There's a 9-figure brand in here. There's 5 or 6 8-figure brands, and then add on to this another 1 to 200 7-figure brands, and you've got a bit of an idea for the experience that we have on Meta ad accounts. Profit contribution meets Meta ads. There's really 3 objectives that I wanted to pull out of this presentation that I want everyone to walk away with. I want people to understand how to link contribution margin to in-platform Meta KPIs. The reason for that is that one of the most common gaps that I see within e-commerce brands is financial literacy. No one gets into starting an e-com brand because they want to do finances. And there's no real solid service that also closes that gap in the market as well. There's SaaS solutions that are really great, like StoreHero, which give you some objective data that you can use to make making off. But the actual training application of understanding financial literacy and then taking that a step further and actually being able to link it into application within marketing is such a missed skill within the market that I hope I can provide a little bit of clarity throughout this presentation on how to do that. I also want to quickly touch on how lifetime contribution margin can be eroded by poor account structure. And then lastly, I'll give the structure of an account that you can roll out in your accounts. You can ask questions at the end behind why we structure in this way, so you can have context as to what this looks like in application. I want to start off with what is the purpose of paid media, because I think there's core axioms that you need to agree upon to then build a framework in which you're going to apply paid spend through over time. And the first is, why are you even running paid media for your brand? And the reason why you're running it is to acquire new customers profitably. The purpose of paid media spend is not to retarget existing customers. Now, you can have pushback and make solid arguments that there is an attrition period of existing customers in which you might want to treat them as a novel customer. And there's always going to be these edge cases. But generally speaking, for 7-figure brands, you are not running paid media spend to get existing customers back. In fact, we've run a lot of incrementality studies internally where we spend more on returning customers to see, well, if we can spend more money on these existing customers? Can we get a better return than going and getting new ones? And the answer is no. I've never seen any conclusive data ever that's proven this, and I'll stand on the hill until I've been given good data that says that you should go and spend a bunch of money on existing customers through paid media channels. Where you want to start is you want to determine correlation between acquisition MER and attributed ROAS. If you're familiar with StoreHero or any of the content that I've put out, this should make sense, but I want to define acquisition MER, which is that MER by itself is total net revenue divided by advertising spend. Acquisition MER is just taking new customer revenue and dividing it by advertising spend. The reason why that delineation is important is because of the core axiom that we've just built towards, which is that you are spending on paid ads to acquire new customers. So why are we including returning customers in your core KPIs? Then if you can try to find a connection between this true financial figure that is represented in your P&L within the platform, then you can actually start to make decisions on where to distribute budgets that actually align with increased profit. If you're wondering how acquisition MER ties into profit contribution, it's acquisition MER and volume that produce profit contribution, which is why it's such a good metric. And that's why Karl spent time on it, because it's essentially a maximization function for getting as much volume as possible whilst also maintaining an efficiency target that can hit you on that peak of the curve. And so if you can do this correlation, you can maximize for profit contribution. And there's two ways that you get these numbers to converge. You're going to go and look at your acquisition MER number. You're going to go and look at your Facebook ROAS, and they're going to be completely different. You're going to see maybe a 3 acquisition MER at a store level, and then in the platform, it's going to tell you you have a 9 ROAS. And so there's immediate disconnect in decision-making. And this is where, when you're making these micro decisions on a day-to-day basis in the platform, you're making decisions based on vanity metrics that have no connection to actual P&L outcomes. And so that's where the disconnect starts. And I'm going to show you a real example of this in a second. First thing you want to do is you want to switch your attribution models over to 7-day click. There is a ton of over attribution that occurs through what's called 1-day view attribution, which is the default attribution setting within Meta. What that means is a user can be served an ad, they don't interact with it in any way, and Meta can still claim the conversion within 24 hours. Now, technically speaking, how Meta can claim that conversion is because the user has already hit the site previously. So they've already triggered the pixel code to be able to correlate to an individual user. And so view through conversions typically will only work if a person has already visited the site. And so because of that, you end up with significant over attribution on either returning customers or on people that are very far down their purchasing journey and we're going to buy it regardless. And then number 2 is you want to implement heavy audience exclusions, or you at least want to be able to segment audiences within the platform to be able to delineate new versus engaged versus returning. If you don't have heavy audience exclusions on cold targeting campaigns, they will just prioritize warm audiences or existing customers. Here's an example of a brand that we onboarded like a week or 2 ago. And here's their data in Jan. And so in Jan, they were running 7-day click or 1-day view. Their ROAS was a 2.14. Now, if you go and take a look at their first-time customer P&L, and so this is where we've taken all their data, we've cut out returning customers. We're just looking at first-time. Their acquisition MER was a 1.41. So immediately you can see a bit of a disconnect between revenue and platform, actual new customer revenue. In fact, you can look at the figures. It says 56,000 in net revenue. Over here, it says 79,000. So obviously that's over attribution coming from returning customers. Now, what you can do, and I recommend taking a screenshot of this if you want to do it after, or I'm sure we'll have a recording of this, is you can go to columns. You can go to compare attribution setting. I don't know why they hide this setting under columns. I think they want it hidden. And then you can click 7-day click and you can click apply. And that's going to pull out every metric that relies on attribution through the pixel into 2 separate columns. You're going to have your original figure and you're going to have just your 7-day click figure. And you can see the ROAS for this brand immediately drops from 2.14 to 1.68. And so we're starting to converge towards the actual ROI that they're seeing within the P&L, where revenue attributed has dropped from 80 down to 62. So it was like $16,000, $17,000 worth of over attribution already. There's a question here, before reporting on 7-day click, what's the most common attribution window? Meta defaults to 7-day click or 1-day view. So every account, I would say 95% of the accounts that I audit are running on 7-day click or 1-day view. No, almost no one runs on 7-day click, at least the accounts that I see. And so this is why I included it in this presentation, because it's a really quick win that most people aren't doing. It gets even more important because you could look at this and you go, okay, cool, we kind of have a little bit more accuracy here at an account level. But where it gets really important, and this lost this brand thousands of dollars, is look at the individual campaigns. This middle campaign, they cranked this campaign up to spending 60 to 70% of the account-wide daily budget because it was a sales-based campaign that had the strongest ROAS. It had a 2.21. Reality is, it actually has the worst attributed ROAS out of all of these campaigns. Why is that the case? It's a sales-based campaign with no exclusions on it. And so it's just heavily prioritizing retargeting warm or existing customers. And so you've just got a ton of over-attribution in here that isn't incremental. And so they went and layered a bunch more spend into here thinking, oh, this must be the solution. And this wasn't in-house, this was an agency doing this. And they dropped into a negative first-time customer P&L. So what we have here is CAC over time, cost to acquire a customer. Over here, we have gross profit on first purchase, including cost of delivery and transaction fees. And you can see that in the month of January, they dropped to one of the worst LTCM to CAC ratios, which is just the relationship between those two numbers, that they've ever seen. It's the highest blended CAC that they've ever had since the inception of the business. And that is literally just because the agency made the decision to put more budget into the campaign that seemed to be doing well, but it wasn't actually incremental. And so that's why having clarity over the actual impact or the relationship between ROAS and the impact on the back end is really important. You can take this a step further and you can click on breakdown and then audience segments, which I'm sure everyone's across, and it will break down now ROAS into what Meta will define as new customers, engaged customers, and existing customers based on the lists that you provide. I wish I had an additional slide after this to show you what it would look like, because I guarantee the new audience row would have converged exactly to the acquisition mode number that we saw previously. But funny enough, this agency didn't have this set up. And so you can't even see the data. So if you don't have this set up, strongly recommend going in, set up your audiences so you actually have clarity over the data. Because I see a lot, you go to 7-day click, you do the audience segment breakdown, and you suddenly find out that an account that was running on a seemingly 4, 5, 6 ROAS is actually running on a 1.1 on 7-day click new audiences. And so it's no surprise that their acquisition mode on the back end is a 1.1, right? You can actually find the correlation. A little bonus consideration here that's outside kind of the scope of this presentation is just that campaign as well had a landing page view to link click ratio of 62%. So if you're not using this metric, I recommend creating it. It's a custom metric. It's just landing page views divided by link clicks. And it's going to show you the percentage of people that actually load the page and trigger a landing page view pixel limit. And so what that essentially means is 40% of people weren't even hitting the website. They've got a CPC of $4.50 there. Adjust for the fact that 40% of these people aren't even hitting the website. It's like an $8 to $9 CPC. I don't know in what world an e-commerce brand with $100 average order value is profitable with $9 cost per click. Like that's a reasonable cost per click if you're a high ticket services-based business that has a 40K LTV. On a $100 average order value e-commerce brand, the metrics will never stack up. And so that's an immediate red flag that the numbers that we're looking at here don't actually correlate to better financial outcomes. I think that gives you a little bit of an idea now as to how to link contribution margin to in-platform KPIs, but I don't think it takes it further enough. So I also want to talk about attribution, which Karl touched on, and I want to give you an alternative. I'd encourage you focus on incrementality over attribution. Attribution's an incredibly compelling idea because the idea of attribution is that you can accurately assign appropriate value to every action so that you can perfectly allocate your dollars relative to their impact. And so if you can find through attribution that most people find you on a top of funnel meta campaign, but then all of the rest of the journey happens on Google across a multitude of campaigns, you're able to take your total marketing spend, allocate it efficiently across that funnel, and therefore have no wasted spend. The reality is it's kind of a pipe dream, and that's never going to happen. And I could spend 40 minutes talking about this, but I'll give you a couple of reasons why. Every attribution model has a flaw. No matter what attribution model you pick, there will be multiple disadvantages of using it. And what ends up happening when you have a meeting of a few people internally and you try to decide what's going on is everyone will choose their own attribution model based on their own biases. And that will just lead to an obfuscated discussion where there's no clear outcome or actions that can be taken objectively off the data that's collected. And so as Karl said, did profit contribution go up or down? Okay, don't do that again. Okay, do that again. But if you're now trying to triangulate a customer journey across multiple different sources, Triple Whale, in-platform, Google Analytics, and you're trying to tie all the pieces together, you just end up with really confusing decision-making that ends up not moving the business forward. What ends up happening a lot is that if you have overspend on one particular platform, or you're like really reliant on one platform but not on another, is the platform that you spend more on gets under attribution, the platform that you spend less on gets over attribution, because the other platform just retargets the top of funnel traffic. And then you can double click into a platform here and look at Meta, for example. And if you run a cold targeting campaign with heavy exclusions, and you're also running an Advantage Plus campaigns with no exclusions, you look at the two campaign types, you might think, oh, they're similar, they're both going after cold audiences. They're not. The one up the top is going to get significantly under attributed in terms of ROAS. And the one that's enabled to be able to retarget users is going to get significant over attribution. So as a business owner, attribution seems like the answer to your problems, but the reality is that if you over prioritize attribution, it just ends up being the detriment of your business because you can't make clear decisions. And you need to be able to have a clear decision-making framework to be able to actually push the platforms forward and be confident in spending more money. So my recommendation instead is incremental lift. And before I touch on it, I'll answer the question, which is, what about using multi-touch attribution? I'll give you an example of like what was kind of breaking the camel's back with attribution for me, which is that I looked at a brand and they got Triple Whale, they're spending a ton. And I wanted to look at first click attribution to get an idea of like, where is the first click that's generating the funnel for customers? And where all the first click attribution was coming from was Facebook retargeting. Doesn't even make sense. Like the person's visited the website and then they've hit a Facebook retargeting ad and that's the first point. Like it's no. So what's happening there is that the attribution platforms can't effectively track back far enough through a customer journey to be able to get correct attribution on first and second click. And ultimately those are the clicks that actually really matter. And so the tech just isn't good enough to be able to, at volume, give you perfect allocation of dollars across a media mix. What can give you a much better idea and a lot more confidence, and everyone can sit in a meeting and rock up to it and look at two numbers and go, oh, okay, we should do more of this or we should do less, is an incremental lift experiment. There's three ways you can do this. Number one is you can run them natively within Google and Meta. They have their own tools that allow for this. Number two is you can use third-party SaaS solutions. Kind of hard to get access to. You've got to be doing over 50 mil online to be able to even use them. And so if you're at that stage, reach out to me and I can give you some recommendations. Otherwise, you've got the third option, which is manual correlation testing, which I'll give you at the end of this, the Google sheet that will allow you to do this yourself. I'm not going to explain how GeoLift incrementality testing actually works in this webinar because it's going to take me 10 minutes to do so. But if this is my recommendation that you should be aligning your team with outside of attribution, you should understand how it actually works. And so I strongly recommend that you open up YouTube in a separate tab and search for how GeoLift incrementality testing works, BlueSense Digital, and watch this at some point if you're going to go down this route, because you need to fundamentally understand how this thing even works if you're going to go and use these tools. I'll also give everyone in the webinar, and I'll drop my email after this so you can just ping me an email and I'll give it to you, is a basic incrementality testing model that I've put together just for this webinar. So how this works is how an incrementality test works, before I explain how the sheet works, is you take a campaign, you take a hypothesis. Let's say if we go back a few slides, it's this campaign up the top. And you make the hypothesis that we believe that it's getting under attribution. And this is actually going to drive incremental sales if we put more spend here. And then you simply go and you put more spend there. And so you go and put an extra 3, 4, 5, 6K a month or a day into that campaign, and you measure whether new customer revenue on the back end actually increased. And if it didn't increase, okay, maybe that didn't work. If it did increase, fantastic. You can measure the incremental ROI of how much increase you got versus the spend. Now, I'm going to get a lot of backlash on that because it's a little bit more nuanced than that, because what's giving you confidence that the increase in new customer revenue came from the spend, it didn't just come from natural fluctuation? It's a very fair objection. And that's why GeoLift tools actually exist, is because they try to counter out and track control variables to give you a more precise answer on the incremental lift. But if you're a small brand doing 1 to 4 mil, you don't need to really do confusing controls for seasonality, etc. You could literally just see, if we double our spend, how much does revenue go up? It's pretty clear. You do have to account for the fact that there is a delay in customer purchasing journeys. And so when you crank up spend, you're not just going to get more purchases today if people on average take 7 to 10 days to buy. And so you want to make an adjustment there. But that's going to give you the best clarity into, if we put more spend into a campaign, what are we actually going to get out of the back end? And this sheet, I'll have a tutorial on this as well, shows you how you can do that. Keep spend stable for 2 weeks, bump spend up, drop all your data in here from Shopify and your ad accounts, and it will tell you the actual incremental ROI per extra dollar spent, and it'll give you a percentage lift analysis, and it'll also graph it so you can cleanly see what's actually happening. For context, with this brand, when they spent more, their revenue went down. And so pretty clear that the spend was not incremental, which means that you need to step back and rethink where the spend's going, why that campaign didn't work, and ultimately try again. Once you do this a few times, you want to keep a log, and you want to start determining discount factors at an individual platform or campaign level. And so an example of this is that if you had a PMAX campaign that had a 5 ROAS, and you ran a test, you want to put an extra $2,000, $3,000 into this campaign, and you only saw a 3x incremental lift in your revenue. Now, this could be acquisition, MER or MER, whichever one you want to look at. We now know that if we want to put more spend into a PMAX in future with a similar structure in a similar environment, that it's only going to deliver a 3x incremental ROI. And so we're going to go and place a 40% discounting factor on either just this PMAX, or we could even expand it a little bit and just say all of our PMAXs. So if we see a PMAX on an 8 ROAS, we know that if we put an extra 5K in there, we're not going to get an 8x on that 5K. We're going to get a 40% reduction on that ROAS and then run the math out from there. And so this starts to give you a lot of clarity in terms of decision-making in the platform and the campaign level on where you should be applying budgets to be confident in seeing growth. And then if it doesn't work, you also get very conclusive data out of the back that it didn't work and that you have to rethink the approach. Alternatively, if you're just using like obfuscated attribution models and trying to figure out where people are pathwaying through this PMAX, you'll sit here for 30 days trying to figure out what's going on, when you could just run an incrementality study for 3 to 4 weeks and get a very clear idea almost immediately and just move on. Understanding how lifetime contribution margin can be eroded by poor account structure. This is a really simple one. It's one slide. I'm not going to dive too deep into how we broke up the unit economics at an order level here, but there's just one important thing to look at, which is this is real data of a real brand. They're first-time customers. When we break down how the order is constituted together, they end up with a profit contribution at a unit level of $51. So each new customer they acquire, they're making $51 in profit contribution. This is the exact same concept that Karl ran through with the pie chart. When you look at returning customers always have significantly more profit contribution to the business. And this is something that I think is overlooked by quite a lot of early stage e-com brands. There's 2 reasons why. Number one, you have generally considerably higher average order value because when people come back, they have higher purchase intent with the brand. And you can see that in the units per transaction here. And so returning customers will buy almost an entire additional unit in compared to a first-time customer. But not only that, you have no marketing expense. You have no CAC associated with a returning customer, unless you go and spend a bunch on paid ads and you build a CAC in. And so if you are going and spending 20, 30, 40% of your budget accidentally on existing customers, which everyone almost does unless they're really stringent on this point, you'll just end up with a $24, $30 CAC in here as well. And it's really easy to do that because you do way less volume on the returning customers. So you don't have to spend a lot to really add quite a large CAC on here. And now one of the biggest advantages of having a direct-to-consumer e-commerce brand is that you have own first-party data and you can directly get repurchases through that first-party data. Advantage is lost. You're now just eroding margin out of returning customer revenue and profit contribution. And a lot of brands are super reliant on propping up their overall profit contribution from their returning customer profit contribution. And so the second you start messing with that, it's not a good position to be in. How to structure an account for profit contribution, not ROAS. If you want a structure for how to maximize ROAS, let me know and I can give it to you, but it doesn't matter because you're just going to get over attribution as we saw earlier, and it's just going to confuse your decision-making process. This is the general structure that we'd recommend in conjunction to a retargeting campaign, which is having a dedicated testing campaign, which is an ABO, optimizing for conversions. You have tests running at the ad set level. When I say tests, these are almost always creative tests and nothing else. You have key performance indicators in place that are leading indicators rather than lagging indicators. An example of that is CPCs comparative to low volumes of attributed purchase numbers are going to actually be better indicators as long as you're using conversion-based targeting. Goes into an analysis process. If you have a success, the biggest mistake I ever see, I see this actually a lot, is people will go, okay, time to pause our successful ad set and then let's relaunch it in our scaling campaign. Don't do that. Don't do that. You're just going to reset learning phases. Some people don't even pull post IDs, and so you're going to lose all the social proofing. If something's working, put more budget into it. This is just like a nomenclature difference. You can call this campaign whatever you want. When you have high performing assets as well, what we're seeing at the moment, this will probably be updated in 3 to 6 months because these things change all the time. But taking post IDs, putting them in dedicated Advantage Plus scaling campaigns with 0% existing customer budget caps seems to be working really effectively at the moment. Making sure there are heavy audience exclusions, making sure this is on 7-day click, and everything that I mentioned previously is obviously inferred. If we double click at the ad set level, we recommend splitting up tests based on concepts and then having iterations of different creatives on those concepts. What I see as a really, really common mistake is people will approach creative testing at a medium level. And so they will see that, for example, video is doing really well, and they'll go, oh, videos do well for our brand. Statics don't work. GIFs don't work. That's not what's happening. It's that you more effectively capture attention, communicate the product, and drive action through a video than you currently do through a static. You don't know how to effectively take that concept and that messaging and drive it through a static or a GIF. And so it's actually a lack of skill rather than an issue with a particular creative medium. It's like people have been running posters and billboards forever. They work. There is incrementality in a static. It's just that you don't know how to effectively communicate your product and drive action through that current medium. And I would recommend that you start approaching creative testing in that way, where rather than siloing out, oh, GIFs maybe work better, videos work better, let's actually test them against each other. It's how do we, irrespective of medium, it's does the concept work? Does this concept actually drive action and produce outcomes? Because if the concept doesn't work, it doesn't matter what form you put it in, it simply will not work. So just a recap. Number one, focus on new customer acquisition. Primary focus of paid media is to profitably acquire customers, not to retarget those you already have. Go for incrementality over attribution. Stuff like view-through conversions is just going to mislead you, and it's really going to mislead you in terms of budget distribution at a campaign, at an ad level. So focus on measuring incremental impact. Geo-lift tests within the platform tools are going to be your best bet. There are disadvantages of them. There are advantages of manual correlation, but generally it's going to be a much better true impact of advertising spend comparative to attribution. Once you have done that, apply your discounting factors, write this down somewhere, have a doc within your company that says, here's all the tests we've ever run, here's the discounting factors we assume, use that as your Bible. Data integrity is absolutely crucial. We saw that in the example I pulled up before. If you're misinterpreting data because it isn't structured in a way that actually connects to the P&L, and you can't draw those correlations, you are going to make bad decisions. Don't spend on returning customers. I don't know how many times I can say it. And structure creative testing by concepts, not by medium. Don't go and split test videos versus statics and use that as your creative testing. Instead, bundle concepts together and test the underlying concept to a target audience. It's going to help you better delineate your split tests, which is probably the final note, which is that when you are doing split tests in those cold targeting campaigns, don't split test the color of a background. Don't split test some tiny headline variation. Make the tests as large as possible so that you can actually take conclusive conclusions away and then use that for future iterations. People can sometimes end up in a cycle where they're split testing useless, meaningless variables that have no impact. And then they begin to create a narrative and a story through the ad account that says, oh, we don't do this, we do this. We don't do this, we do this, because of these old tests that were grounded in absolutely no statistical significance.
Fantastic. Really great stuff, Nathan. A lot of tactical stuff there. I think oftentimes, again, it's easy to talk about this in a broad sense, but being able to practically the decisions that people are making are within that Meta Ads account on a day-by-day basis. So there's plenty to work from. So just in the meantime, we want to just finish up, bring us up to the hour, and we're going to do a bit of a Q&A here. So ultimately, everyone who would have signed up and attended had an option to enter some questions. So we have a ton of questions to actually kick us off. In the meantime, as we run through a couple, if there's anything live, please let us know and drop it in the chat. We'll try to prioritize those as they come up as well. So I might take the first one on my side and then I'll throw the next one to yourself, Nathan. One question here is how to calculate CAC targets per category or product according to contribution margins. So ultimately, the question around how much should I be willing to pay for a customer is ultimately based on, in my opinion, and our approach is based on what that customer is worth to you. So ultimately, no CAC target is equal, similar to how no ROAS is equal. If you want to spend $20 to acquire a customer, what's that customer going to drive in contribution margin dollars now, today, and also over time? So just to give an example that I usually use as a bit of a reference point for this, some businesses will want to look at their lifetime value in different ways. So on one end of the spectrum, you might have a furniture business. This business is what, unless you're the best salesperson in the world, you're not going to probably sell a sofa every month to the same person. So with that in mind, when you do drive that sale, you may not expect them back within a reasonable period of time on that SKU, just to keep things simple. So with that in mind, you need to be first order profitable. So ultimately, that kind of gross margin you generate on those customer orders, that's often the be all and end all in the context of the marketing decisions and spend allocation decisions you're making. On the other end of the spectrum, you might have let's say a supplements, health and supplement subscription brand. You have a high degree of predictability based on data and based on past performance that a customer that you acquire will renew over the next 3, 4, 5, 6 months. So you can ultimately accumulate or see what gross profit you can generate off those first couple of orders. Oftentimes we see a business maybe say, okay, I'm second order profitable, but they don't actually take time to understand when that second order is taking place. If that second order takes 14 months, there's a cash flow implication of that as a business owner. If you're waiting, it's like, if you've maybe a negative margin or negative contribution margin on first order, maybe of minus $10, let's say, and if you've thousands of customers being driven through your store, it's like you're giving a mini loan of $10 to thousands of people, and you're waiting for them to come back and repay that loan in order to drive profit within your business. So ultimately, you need to make a rational decision as to how likely is that person willing and able to pay that loan back, that kind of negative customer acquisition cost. If you're in a furniture business, you may not be willing to make that bet and take that loan. On the other side, if you're a subscription business, that actually might be helpful to look at. So what I would typically look at is look at the overall kind of gross profit you're generating after that maybe 12-month period of time, which is most common, and understand, okay, are we generating more profit today, or am I generating more profit between, over the next 12 months? If you're generating most of your profit on first order, you probably should maintain and not overspend to acquire that customer. If you're generating most of your profit after today, after that purchase, potentially looking a little bit further down the line, maybe something to consider. So just a question for yourself, Nathan. I think ultimately there's a really good one around using Meta for bottom of funnel and retargeting rather than using a brand awareness. So an important bit of context here is it look like this brand is a reseller. So with that in mind, potentially thinking that there's some hard work already done in advance around that initial brand awareness piece as a reseller, potentially building on top of that brand equity that's built. So if you're looking at that kind of more bottom of funnel approach, how would you approach that account structure?
Yeah, cool. Just to clarify as well, so it is that they don't want to run heavy cold targeting on Meta and they just want to scoop up retargeting?
Yeah, retargeting rather than brand awareness. So there's an assumption set there, or there's a pre-built assumption in the question, which we can maybe question if that's right or wrong. So I'll leave it open to your interpretation.
Yeah. Okay. Cool. Nice thing about being a reseller. So the unit economics of a reseller are interesting, which is that your gross margin gets squeezed substantially. Normally, let's say after cost of delivery and transaction fees, you're sitting at 30% gross margin is pretty typical from what I've seen. In which case you have to operate on an incredibly efficient MER, generally speaking, like 10%. So you need a 10x ROI. Now, how does that even become viable? It's because there should be products being bought within the store. And so this really comes down to how competent the buying team is, that have significant demand existing within the market caused by the brand who's actually driving the marketing. Really good example of this is Nike, right? If Nike comes out with a new shoe and you stock the shoe, I can guarantee you put that in a dynamic carousel or you put it in any ad format on Meta, it will do incredible. It'll come out of the gates at 15 to 20 ROAS. You won't have any problem in terms of efficiency targets. And that is only because Nike has gone and spent billions of dollars in advertising. And so people immediately recognize the product. There's a high CTR, there's a high conversion rate. Not only that, Meta identifies that it's a Nike product and will serve to people that are currently within their purchasing journey on a Nike product on other stores. And so you'll notice that if you look at any kind of Nike product, you'll suddenly be retargeted on Meta by all of these different resellers that are selling the same product. And it's because that's how Advantage Plus campaigns work in terms of the mechanism for serving, is that they're going to use purchase intent of existing products that people are looking at, and they'll just take all the competitors and serve all to the same person. And so you're in a unique position there where I would probably just start with dynamic carousels on basic retargeting 90-day visitor campaigns. As usual, I wouldn't spend on existing customers. You probably don't have great cohort growth unless they're like CPG products. And then I would honestly launch cold targeting with heavy audience exclusions and just run a dynamic carousel with the products that you believe are in highest demand. And that's probably going to do well just right out of the gates, as long as you are stocking products that people actually want and that people are knowledgeable of. Where people get into a real rut and where we've had issues in the past with like reseller websites is when they're just stocking products that nobody wants anymore, or it's going to be a fad and it's gone out. And that becomes really difficult because if the brand that you're stocking isn't spending on paid media, you're climbing an uphill battle.
Definitely. Just to add to that as well, we often see that situation where, as everyone knows, operating from different industries and perspectives, there's no free lunch. In some situations where maybe you're a high margin direct to consumer focused brand, not a reseller, you ultimately benefit from those larger gross margins. But ultimately those industries often tend to drive more competitive advertising. You've more competition and in turn potentially need to invest in that kind of higher customer acquisition cost because you don't have as much of that brand equity. On the other side, if you're maybe reselling or building on top of that brand equity, you potentially don't have to spend as much to acquire that customer, but you can't afford to spend that much to acquire a customer because that margin is tightened. So there's ultimately a lot of different versions of that pie chart that I ran through with that in mind. And I think largely speaking, just make sure you're not stuck in the middle there. And ultimately building a plan based on your own unit economics. Just to kind of take some of these questions from the chat, Justin has asked, given that maybe for yourself, Nathan, so given that an account has minimal data, do you think it might be more effective to lean into 7-day click plus 1-day view initially to help build more data, and then later shift to that approach? Does this affect the reliability and accuracy? And I suppose in turn, will it lead me to different conclusions? Is it a stepping stone, or is it diverting another path, I suppose?
Yeah, I think I'd look at it as a stepping stone, but you'd want to be a really small account. If you're small enough and Meta Ads is your only acquisition channel, you can then be pretty over attribution isn't a problem then, because you want to attribute every single conversion that occurs on the website, because Meta is responsible for every single conversion that occurs on the website. It's once you start to achieve volume that definitely view through attribution is going to ruin your decision making. And so the answer is yes, I would use 7-day click, 1-day view on a very brand new store, but it's nuanced, because I'll give you a counter example, which is that there's a brand that we might be working with over the next few weeks who already does $250,000 a month on Shopify, but they have $0 in spend on any advertising right now. It's all SEO. And so if you come out of the gates and you make the argument, well, we're going to use 7-day click, 1-day view on our new Meta campaigns, to collect more data, you're just going to end up with crazy over attribution almost immediately. And you could make an argument that data accumulation is going to occur within 48 hours, and then you want to switch to 7-day click. And so I don't even see the point, because you have to delete the campaigns and then start new ones and reset learning phases. You may as well just jump straight into the correct way to attribute immediately.
Nice. Lorenzo has a question in a similar vein. So how do you look at incrementality tests with meta audience in a testing campaign, especially with low 7-figure brands? So Lorenzo said he likes doing audience stack with concept lookalike stack before expanding the highest data points first, then broad. So ultimately, the kind of takeaway I would have from this question is around, how detailed are you, how granular are you going, defining different audiences, or are you letting Meta, just to kind of try to broaden this question out a bit, are you letting Meta come to its own conclusion, starting with broader, or kind of putting your hand on the scales to whatever extent?
Yeah, I'd recommend going broad in 90% of instances. I'm not a massive fan of narrowing down into interest and audience testing, and we still do a lot of tests on that at the moment. I literally launched an ad set 4 minutes before hopping on here, which is an interest stack, because I want to see if I'm still right in running completely broad on this particular account. And I think I will be, because I haven't seen interest in audiences really scale effectively and be able to hold ad spend for an ongoing basis compared to broad.
Just to kind of speak to our experience in this, I think ultimately more often than not, we see people, overcomplicating their approach in the context of targeting. I think we've been kind of negatively trained a lot of the times to require a lot of deeper interest targeting, because ultimately the platforms in years gone by required that of us, because the kind of machine learning capabilities, the pixel tracking for all its flaws, ultimately wasn't as intelligent about understanding who our customer was and wasn't. And ultimately we need to maybe understand where are we best to put our hand on the scale. It's ultimately more around the stuff that Nathan covered there, rather than just necessarily getting in Meta's way in areas where it can actually serve us better, maybe.
Yep, cool. I agree.
Perfect. Observation and kind of comment from Oscar there, long for the day of offline ads, magazines and TV. And I think that probably speaks to a broader point as well. One way I tend to make this point is, advertising and marketing spend isn't treated as a variable cost, but it's potentially one of the most variable costs. And if your supply chain cost, your product cost varied as much as your advertising spend, a lot of people would shut up shop. That would not be a very reliable, clear, easy business to run. So ultimately, again, that's only speaking to the benefit of contribution margin and treating that with the level of kind of focus and clarity. It's not an afterthought. It needs to be part of that initial conversation as well. Cool. And then finally, maybe just to touch on, last question here within the notes. So attribution models to use if you run both Google and Meta. So I think, Nathan, from your perspective, you did touch on this as part of the actual slides, but maybe just in case there's anything to finish up on. One thing that I just add to that as well is, again, everything needs to be looked at in context of your, broader, store level efficiency metrics like your MER and AMER, that it ultimately isn't skewed by any platform. That's the way we try to think about it, that while the platforms will certainly give those signals, it's less around finding this perfect middle ground that, triangulates between the platforms and your store. It's okay, what's that discounting factor you need to apply? One example of this is maybe the likes of, TikTok ads. It ultimately looks maybe more similar to a Meta in the sense that it's more upper funnel versus your Google, which as part of, they're lucky in that sense that they're closer. They often are closer to that purchase and can often take more credit in some situations. And, with that in mind, you'll see the likes of TikTok really focusing on doing partnerships with those third-party attribution platforms in order to try to build a solid case as to why they deserve that spend over a Meta and Google. So personally, what I would say before handing it off to yourself, Nathan, I would say, again, think about it in context of your actual purchase journey, what you really feel people actually follow. It's not necessarily something that might change every day to the extent that you need to adjust and check that every day, but you'll have a general sense of what your customer's behavior looks like. If it's a demand creation kind of purchase, whereby it's not something they're actively searching for, where versus a demand capture approach, whereby someone is actively searching to solve a problem that your brand can fulfill. And with that in mind, you can apply those discounting factors with that in mind. Maybe Nathan, do you have anything to add there?
Yeah, I agree with everything that you said, which is you just want to be able to do your best to delineate warm versus cold audiences within both of these platforms, and you want to do everything you can to have stringent walls in place for that. And so brand search campaigns are a great example of that on Google, and brand exclusions in PMax is a great example of that as well. If you don't have brand exclusion set up, PMax will just completely retarget. It will not be incremental. There'll probably be a ton of wasted spend in there. You want to make sure that it's not doing that so that you can have a increased degree of certainty on the incremental impact of the campaign.
Nice. And just a last question there, because we're running over in time and it's also 11 p.m. here, so I should probably go home. Nathan, with your experience, or from your experience, how many new ads should a brand be launching a month on Meta? So I would guess it's going to be somewhat to do, the first answer is probably that depends.
It is, yeah. I'll give you a formula, which is look at your budget on Meta, put a percentage allocation towards testing, then spend 3x your average order value on each test, and that'll give you the math on how many creatives you can test per month. The short answer is no one tests enough. I can almost guarantee 90% of brands aren't putting enough creative in the account. Pareto's principle applies in creative, and Pareto's principle applies in Pareto's principle. And so 80% of your ads won't work, 20% will be okay. And then out of the 20% that are okay, 80% of them won't really scale. 20% will actually scale and hold significant volume of spend within the account. And so you end up in a position where it's 5 to 10% of ads are really going to drive your account to spending $100K a month. Any single account I have ever seen in direct to consumer that isn't relying on omni-channel and stores that has scaled to 100K plus per month in spend, it has always came from 4 creatives. There's they just got to hit on one, they got to hit on another, they got to hit on another. And collectively, they were able to hold $250,000 in spend altogether, which allowed the account to take off and get volume. And the only way you get those high performing ads, you can sit around and have a pen and paper and just try to ideate on what is going to be the perfect ad that's going to hold $250,000 in spend. You'll never figure it out. You just need to introduce hundreds of ads into the account that are all at a quality in which you would be happy with, and that you would have certainty that one of these could be a high performer. And then the percentage hit rate rule will come into play, and you will get ads that work and that can hold a lot of spend.
Fantastic. Great. I think we'll leave it there. Thanks again, Nathan, for your time. Really a lot of tactical stuff, as you said. Excited to kind of get this playback out as well to not only people on the call today, but ultimately I know there's going to be plenty more that will get value out of this content over the next couple of days and weeks as well. So just before we sign off, maybe Nathan, you can give some context on where people can find you. In the meantime, I'll throw your email up out there as well for some of those resources.
Perfect. Yeah, I'd go straight to the YouTube channel. We put videos on there every single day. There's actually not a video going up today because I'm recording this, but there normally would be. Highly recommend checking that out. Go to my LinkedIn. Also go to the website if you're an e-commerce brand doing over $1 million a year. And we can put together a 40 to 50 minute audit video for you, going through everything I've gone through, but contextualized to your actual business.
Fantastic. And just to sign off from my side as well. So if you want to learn more about StoreHero and taking a more profit first view of your business with the platform, and to kind of, again, try to separate the signal from the noise, by all means, would be delighted to chat to anyone at storehero.ai. So yeah, thanks again for everyone's time. I really appreciate it. And yeah, I hope to see you guys soon. Thanks a lot.
Thanks, Karl. See you later.